Silver just crushed nearly every major asset this year. Quietly, without dramatic headlines, it climbed to become the third most valuable asset in the world. And while most investors were focused on price charts, China made a move that completely reframes the story. They stopped selling silver. That single decision matters far more than any daily price move, because it is not a trade and it is not speculation. It is strategy. To understand why, we have to zoom out, not just beyond technical analysis, but beyond markets themselves. Silver is not moving in isolation. It is moving inside a much larger shift in how money, power, and resources are structured globally. This is not a story about an asset outperforming. It is a story about control. Start with gold. Gold plays a very specific role in this transition. Gold is about trust in money. It is about reserve currencies and what backs them. And for years, China has been very clear about its intentions. While Western economies expanded debt and relied on currency creation, China accumulated gold. It built the Shanghai Gold Exchange. It expanded what many now call the gold corridor. It encouraged settlement outside the US dollar. The message was subtle but consistent. If you want a monetary system beyond the control of the dollar, here is an alternative. A system backed by gold, stored domestically if you choose, or held within Chinese infrastructure. A system aligned with Basel III rules, where gold can be used as high-quality collateral to borrow and build national economies. Gold restores credibility. Silver does something else entirely. Silver is not about trust. Silver is about function. Silver is embedded in the physical world. It is used in solar panels, electric vehicles, data centers, military electronics, satellites, medical equipment, and advanced computing systems. It is one of the most efficient electrical conductors on Earth. And unlike gold, silver demand does not disappear when prices rise. Industries cannot simply wait. They cannot pause production. They need silver to operate. That single difference changes everything. For decades, one of the most persistent theories in commodity markets is that silver and gold prices were kept artificially low, not to benefit investors, but to benefit industry. Cheap silver meant cheaper electronics, cheaper energy infrastructure, and cheaper military systems. That system worked as long as supply was abundant and demand predictable. But that balance is breaking. Demand for silver is rising structurally. Artificial intelligence, robotics, automation, electrification, and energy transition are not trends. They are policy objectives. And every one of them requires silver. At the same time, China controls a dominant share of silver refining and processing. Now it also controls export rules. That means China is no longer just participating in the silver market. It is shaping access to it. This is where price becomes secondary and leverage becomes primary. Most people assume markets are efficient. They assume prices reflect reality. But in commodities, especially silver, that assumption collapses when paper markets diverge from physical supply. And that divergence is now visible. The Western silver market is centered around COMEX, the main U.S. futures exchange. This is where most price discovery happens. Miners hedge production here. Traders speculate here. Manufacturers manage exposure here. Inside, COMEX approved vaults. Silver is divided into two categories. Eligible silver belongs to someone and is not for sale. Registered silver is available for delivery if a futures contract is settled with physical metal. Here's the problem. COMEX holds roughly 120 to 130 million ounces of registered silver. That is the silver that can actually be delivered. Annual global silver demand is around 1.1 to 1.2 billion ounces. Less than 10% of 1 year's demand is available for physical settlement. COMEX was never designed to supply the world with silver. It works because most contracts are rolled over or settled in cash. Most investors never ask for delivery. The system survives as long as behavior does not change. But systems fail when behavior shifts. Now compare this to Shanghai. The Shanghai silver market reflects actual physical delivery inside China. Recently, Shanghai's silver prices have traded several dollars above COMEX prices. On December 24th, physical silver in Shanghai closed around $78 an ounce. At the same time, COMEX silver closed near $72, a $6 gap. Historically, that kind of spread should not last. Arbitrage traders normally erase these gaps almost instantly by buying where silver is cheaper and selling where it is more expensive. When that does not happen, it tells us clearly that physical silver is not moving freely. Shanghai prices represent guaranteed delivery. COMEX prices represent paper contracts. When the gap widens and persists, it signals tightening physical supply. And when physical supply tightens, paper prices eventually have to adjust. This is not speculation. This is structure. And this is why China, stopping silver exports, matters far more than silver outperforming this year. Because this is not about silver beating assets. It is about who controls the materials that make the modern world function. And that is where this story is really going. To understand what China just did with silver, you have to understand something most people miss. China has already lived through a silver crisis, and it almost destroyed their economy. That experience shaped how they think about money, materials, and power to this day. For much of its modern history, China did not run on gold, it ran on silver. Taxes were paid in silver, large transactions were settled in silver, trade balances were denominated in silver by weight, not by face value. Silver was money. Because China was the manufacturing center of the world even centuries ago, silver flowed into the country in enormous quantities. If you wanted Chinese goods, silver was the price of entry. This system worked for a long time. Silver stabilized prices, incomes, and taxation. It anchored the economy in something tangible, but it came with a hidden vulnerability. China did not control the global silver market, and that vulnerability was exposed brutally in the 1930s. In 1934, the United States passed the Silver Purchase Act. The law forced the U.S. government to buy massive quantities of silver. That artificial demand drove global silver prices sharply higher. For the United States, this was manageable. For China, it was catastrophic. When silver prices rose, silver flowed out of China. Money left the country. The currency base shrank. Prices fell. This was deflation. At first, falling prices seem positive. Things get cheaper. But deflation is poison over time. When people expect prices to keep falling, they stop spending. They stop investing. They stop hiring. Economic activity slows, then contracts. The economy begins to consume itself. China learned this lesson the hard way. By 1935, it abandoned the silver standard entirely and moved to a paper currency system. Not because silver failed as money, but because China realized something far more important. If your economy depends on a material you do not control, other nations can weaponize it against you. That lesson never went away. Fast forward to today. China does not want silver to be its money again. Gold fills that role. Silver now plays a different role. Silver is leverage. So what exactly did China do? China reclassified silver under its dual-use export control framework. That sounds technical, but the implications are enormous. Dual use means a material can serve both civilian and military purposes. Once a material falls into that category, exports are no longer automatic. They require government approval. This is strategic brilliance. An outright ban would provoke backlash. It would trigger retaliation. It would escalate immediately. But regulation is quiet. Regulation is defensible. On paper, China can say it is simply protecting national security. In practice, the rules are written so narrowly that very few exporters will qualify. And even those approvals are discretionary. This transforms silver from a commodity into a gated resource. Why does that matter? Because China sits at the center of the silver supply chain. Most silver is not mined on its own. Roughly 70 to 80% of silver production comes as a byproduct of mining other metals like copper, lead, and zinc. After extraction, that silver must be refined and separated. A massive share of that refining capacity exists inside China. That means silver mined in Mexico, Peru, or Australia often still passes through Chinese infrastructure before it becomes usable metal. Starting January 1st, China effectively gets to decide whether that silver leaves the system or not. This is not theory. China has done this before. Over the last decade, China applied the same playbook to rare earth elements. Today, China controls roughly 80 to 90% of global rare earth refining. Rare earths are essential for electric motors, wind turbines, precision-guided weapons, and advanced electronics. In the early 2010s, China reclassified rare earths as strategic materials. It introduced export quotas and licensing rules. Prices surged. Governments panicked. Only then did the United States, Europe, and Japan realize how dependent they were. Rebuilding non-Chinese supply chains took years, in some cases, more than a decade. Even today, full independence has not been achieved. Silver is following the same path, but with one critical difference. Silver is everywhere. Rare earths are specialized. Silver is universal, and silver supply is inelastic. That means production does not respond quickly to price increases. Even if silver prices double, output does not automatically rise, unless base metal mining also increases. You cannot simply decide to mine more silver on demand. Economists call this inelastic supply. Think of it this way. If coffee prices double, people drink less coffee. That is elastic. If insulin prices double, people still need insulin. That is inelastic. Silver behaves like insulin for the modern economy. Factories do not shut down because silver gets expensive. Governments do not pause infrastructure projects. They pay whatever price is necessary. That is why, when physical silver becomes constrained, prices can move very fast. China understands this dynamic better than anyone. That is why it is locking in contracts, securing supply, and regulating exports before the shortage becomes obvious. By the time markets fully react, the leverage is already established. This is why the silver story is not really about silver. It is about who controls industrial bottlenecks in a fragmented world. It is about who gets to build, who has to wait, and who must ask for financing. And once you see it through that lens, the next question becomes unavoidable. What happens when the rest of the world realizes the gate is closing? That is where this story moves next. So what happens next? Not in terms of price predictions, but in terms of structure. Because this is not a trading story, it is a systemic one, and systems do not change smoothly. They change in steps, often violently, once pressure reaches a threshold. Historically, silver does not move often. It can sit still for years, even decades, doing almost nothing. Then something breaks. And when it breaks, silver moves fast. That pattern repeats across history. In the late 1960s and 70s, silver doubled more than once. In 1979 into 1980, it went from roughly $6 an ounce to over $50 in just over a year. Then it collapsed. Not because the world needed less silver, but because speculative money flooded in and then fled just as quickly. That pattern matters, because it explains why silver behaves differently from almost every other asset. Stocks can become expensive and people can wait. Bonds can lose appeal and money moves elsewhere. Even real estate can slow, but silver does not give the global economy that option. When silver becomes harder to source, factories do not pause production lines. Governments do not halt strategic projects. They pay whatever price clears the market. This creates a two-phase dynamic. First comes the fundamental repricing, when physical scarcity forces prices higher. Then comes speculation, when investors chase momentum and amplify the move. Eventually, speculation burns out. Leverage gets flushed. Prices correct sharply. That correction does not mean silver is suddenly unneeded. It means the financial excess has been removed. The hard part is knowing where you are in that cycle. And the honest answer is that nobody does. Some argue silver is only now catching up to fundamental reality. Others argue that speculation is already dominating and caution is warranted. Both can be true at different moments, and history shows that silver often overshoots in both directions. But focusing on price misses the more important signal. The key issue is not whether silver goes to $100 or falls back to $50. The key issue is what happens to capital flows after the move. Because when one asset finishes its run, money does not disappear. It rotates. It looks for the next imbalance, the next bottleneck, the next underpriced risk. We have seen this pattern repeatedly. Capital moved into gold, then into silver. It moved into technology, especially artificial intelligence. It moved into cryptocurrencies and other hard assets. Each rotation leaves a trail of winners and losers, and each rotation reflects deeper structural stress. Now zoom out again. What China is doing with silver is part of a broader strategy that extends beyond commodities. It is about reshaping leverage in a world that is no longer unipolar. The era where one country sets the rules, controls the reserve currency, and dictates trade terms is fading. In its place is a multipolar system where power is fragmented and contested. In that environment, leverage matters more than cooperation. Gold builds trust. It anchors credibility. It allows alternative settlement systems to function. Silver and rare earths build dependency. They determine who can manufacture, who can deploy technology, and who can scale energy systems. Together, they form a complete toolkit. Control the money, and you influence finance. Control the materials, and you influence reality. This is why the BRICS bloc has been so focused on gold accumulation and localized custody. It is why commodity corridors are being built. It is why trade is increasingly settled outside traditional Western systems. And it is why strategic materials are being reclassified quietly rather than banned loudly. Because in a fragmented world, overt confrontation is expensive. Silent control is far more effective. The silver move is a small domino, but it points to a larger pattern. Control the processing. Control the exports. Control the choke points. And when others need access, they do not negotiate from a position of strength. They negotiate from necessity. This changes how markets behave. It changes how investors should think, and it changes how risk is distributed across the global system. In the past, financial dominance allowed countries to absorb shocks. Today, material dominance determines who feels those shocks first. A shortage of silver does not just raise prices. It delays projects. It disrupts supply chains. It reshapes industrial priorities. And those effects cascade outward. That is why this story matters even to people who do not own a single ounce of silver. Because silver sits at the intersection of energy, technology, defense, and infrastructure. It is embedded in the systems that keep modern economies running. When access becomes conditional, everything downstream feels it. This is the part of the story that rarely gets discussed. The headlines focus on charts and targets. But the real shift is happening at the level of control. Who decides? Who approves? Who waits? And once that dynamic is in place, reversing it is not quick. As the rare earth experience showed, rebuilding alternative supply chains takes years, sometimes decades. And during that time, dependency becomes leverage. So the silver story is not about a metal outperforming assets in a single year. It is about how power is being reallocated in a world moving away from financial abstraction and back toward physical constraint. And that brings us to the final question. If leverage is becoming the true currency of the modern world, what does that mean for markets, for nations, and for investors going forward? That is where this story ends. If there is one mistake people make when watching stories like this unfold, it is assuming there will be a clean ending, a clear winner, a final resolution. History does not work that way. Systems rarely reset overnight. They fracture, overlap, and coexist for long periods of time. What is happening with silver is not a conclusion. It is a signal. The signal is this. The global economy is moving away from abstraction and back toward constraint. For decades, financial markets expanded faster than physical reality. Paper claims multiplied. Leverage grew. Supply chains were optimized for efficiency, not resilience. That world only works when resources are abundant and access is unrestricted. That assumption is now breaking. Silver exposes this weakness because it sits at the intersection of everything that matters. Energy systems depend on it. Technology depends on it. Defense systems depend on it. And unlike capital, it cannot be created with a keystroke. When access becomes conditional, power shifts immediately. This is why China's move is so important. Not because it guarantees higher prices, but because it formalizes control. By regulating exports rather than banning them, China turns silver into a permissioned resource. That single change alters the balance of negotiations everywhere downstream. Manufacturers, governments, and financiers all become price takers rather than price setters. In this environment, markets behave differently. Volatility increases, liquidity thins, paper mechanisms struggle to reflect physical reality. That is when price discovery becomes unstable, not because markets are irrational, but because the underlying assumptions no longer hold. Investors often ask the wrong question. They ask where silver will be next month or next year. That is not the question that matters. The better question is where leverage will concentrate next, because leverage, not price, determines outcomes in periods of transition. Historically, when commodities move from abundance to constraint, capital responds late. It chases performance rather than anticipating structure. That is why these transitions feel sudden. The groundwork is laid quietly, then the adjustment happens fast. Silver's recent move fits that pattern precisely. But this story is larger than silver. It is about a world reorganizing around physical bottlenecks, rare earths, energy infrastructure, food systems, shipping corridors, payment rails. These are not financial assets. They are control points. And in a multipolar world, control points matter more than ideology. The BRICS strategy reflects this reality. Build trust in money through gold, decentralize custody, reduce exposure to external financial pressure, then secure the materials that make modern economies function, not to dominate markets, but to ensure autonomy. Autonomy is the real objective. This does not mean conflict is inevitable. It means negotiation becomes asymmetric. Countries with control negotiate from strength. Countries without it negotiate from urgency. That dynamic shapes trade, investment, and diplomacy long before it appears in headlines. For investors, this requires a different mindset. Traditional models assume smooth transitions, stable correlations, and efficient markets. Structural transitions break those assumptions. Correlations shift. Assets that once moved together decouple. Risk concentrates in unexpected places. This is why focusing solely on price targets misses the point. Silver's role is not to replace gold, stocks, or currencies. Its role is to reveal stress. It highlights where abstraction meets reality and reality pushes back. And that is the deeper lesson here. Every monetary system ultimately rests on something physical. Trust can be created with narratives and institutions, but function requires materials. When control over those materials becomes strategic, markets become secondary to policy. That is what we are witnessing now. Not a collapse, not a revolution, a reweighting, quiet, deliberate, and difficult to reverse. The world is not running out of silver. It is redefining who decides where it goes. And in a system built on leverage rather than consensus, that distinction matters more than any price chart ever will. This is not the end of the silver story. It is the beginning of a different kind of market environment, one where power is measured less by balance sheets and more by bottlenecks, less by valuation and more by access. And if history is any guide, the people who understand that shift early are rarely the ones reacting to it later. I am David Kim, and this is Currency Archives,